Notice anything different? So last time we talked about value and pricing, but your price is only one element in making money. Having a great idea, making something emotional, solving customer problems are great, but by themselves they won't pay your salary. At the end of the day, the business objective is to make money. So we're going to talk about company profit, product profit, and time. So what is profit? Profit very simply is just money in minus money out. So if you think about this in terms of yourself, your money in is your salary. Your money out can be things that happen very regularly, like the tax you pay, your rent or mortgage, utilities, insurance, food. Or it can be one-off payments, vacation, clothes, anything that you buy. And if your salary is more than all of those outgoings, then you have some profit. And maybe you'll put that in savings or investments. And it's much the same with a company, and you can see that through the corporate financial statement. And these are available online for any investor, and they have to be declared to the government. So you can see on a corporate financial statement, usually at the top, there's maybe number of units sold or at least revenue. So revenue is the money coming in from selling things. And that really means if it's a car, that's the money that you as a private customer are paying to your dealer, minus some bits and pieces that's coming in. Then there's the gross profit. That's the profit from selling that thing or service. Then there's the operational profit or operational income. That's the profit from selling the thing, but then also including the costs of running the business, the rent, employee salaries who aren't related to the producing that product or service. And at the bottom line, the final profit is the net income or net profit. And that really is after tax, after all financial adjustments, that really is how much money the company is making. This, I'm not covering here EBIT or free cash flow, which are incredibly important if you're running a company or if you're investing, but they're kind of outside the scope of what we're talking about here. So if we have a look at one specific example, so this is Tesla 2021. So most companies will have several different revenue streams. So maybe different, for a car company, different cars they're selling, or maybe they have different businesses, in this case, energy production and carbon credits. So you add up all of those revenue streams, and that comes to a total revenue of the company, how much money is coming into the company. Then you subtract away the cost of making all of those things. So this is the direct cost, usually what's called the cost of sales or total delivered cost, that's related to those objects. And what you have left after that is the gross profit. That's the first profit figure. So then if you subtract away all of, like I said, the rent, the employee salaries for everyone who isn't directly related to producing a product or service, HR and things like that, then that's the operational profit. And then if you subtract away lots of financial adjustments and tax and investments and things like that, then you get the net profit, really how much the company gets. So we can have a look at several different companies and compare how they match up. So in this case, we have 2020 calendar year, and we have Ford, Tesla, Volkswagen, and Alphabet, who are Google's parent company. So here we have total, per unit, and marginal. So sometimes in different items, it's interesting to look at different ways of analyzing the data. So per unit is literally, you take the total company's profit or revenue and you divide it by the number of things they've sold. And marginal is that profit compared to the revenue. So this is really interesting because you can see interesting things from your competitors. So the strengths and weaknesses of Volkswagen versus Ford versus Tesla's business models. And for example, Google's tax plan, the difference between operational profit and net income. But also, we spoke earlier about how it's really important to understand your customers, and your management of your company are your customers too. So if your company is doing badly in one area, they probably won't approve a new product in that area. If the company's doing well, they might be willing to take more interesting risks as an experiment. And what you want is the resources to get your product built. So you need to understand your customer, in this case the management's mindset and motivations. So in the next video, we're going to talk about product profit. Thanks.